Let's get more now on what Ben Bernanke said today and what it means for your financial decisions. Bruse Kasman joins us. He's the chief economist at JPMorgan. Bruse, thanks for coming on. You know, this is such a critical time, whether you're an investor, a borrower, or saver. Everybody's trying to gauge what's going to happen next for interest rates. Let's start with mortgage rates. Like the 30-year is now at 3.25%. Once the Fed starts withdrawing the stimulus, where are those rates going to go?
Well, I think they're going to go up. I think, though, we need to be clear that the rates will go up because the Fed is responding to a stronger economy. So what Ben Bernanke is telling us is that if the economy continues to strengthen, sometime later this year he could begin tapering purchases. Our forecast is that does happen in the fourth quarter, and that the 10-year yield goes up to 2.5%, and mortgage rates could go up somewhere close to 50 basis points.
So then does it make sense, if you're in the market to buy a home, this is the time to get moving and to buy something before the end of the year and lock in the lower rates?
Well, I think we should look at the long picture here. This is an economy which has plenty of room to run. It's improving. It should continue to improve. Certainly, rates will go up, but I think it's also the case that the labor market is going to improve. People's financial conditions will improve if this is a genuine recovery. So sure, it's a good time to buy and lock in rates now, but the picture should be one of sustained improvement, not of a Fed that's cutting off growth, one of a Fed that's responding to growth.
And what about for investors? You know, we've seen the stock market go from record to record. Again, once the Fed starts pulling back that stimulus, is that going to kill this market rally?
Well, there's going to be volatility. We've certainly seen it today. The market doesn't move in one direction. But again, I think a Fed that is responding to growth, normalizing its policy stance as the economy improves, is generally a good thing. It's only when the Fed needs to raise rates to slow down growth, to face inflation pressures, that we have a problem. And that's far out over the horizon, in our opinion.
Bruse, talk to us about savers. They've been complaining over the last couple of years with interest rates near 0%, really no place to put your money and get a good return on it. What's in for them?
Well, I think it's going to be a very modest rate increase here as the Fed does not begin raising interest rates for a long time. So we're still in a very low rate environment. I think the prospects are that there is going to be a better economy, and over time we'll see returns on savings go up. But right now it's a world where equity markets, where riskier investments are being favored. It's the way to get the economy going. Interest rates are going to stay low here, and perhaps not quite as low as they've been in the last year.
And then the other big question is, how long will Ben Bernanke be calling the shots? The last question that he got today during the hearing was that if he were offered another term, would you accept? And he says, I'm not prepared to answer that right now. Is there any reason for investors and savers to be concerned of somebody else running the Fed over the next couple of years?
I think we most likely will see a new Fed chairman at the end of Chairman Bernanke's term. I think it's quite reasonable to expect continuity, however. I think the appointments that President Obama have made have been very solid ones, and I would expect the same to happen when Chairman Bernanke leaves. He's done an excellent job, but someone else can continue his work.
All right. Thanks a lot, Bruse. Bruse Kasman, chief economist at JPMorgan.